Mohamed, what do you think about what Steve was just laying out, this idea of whether or not there is going to be demand that steps back in when things open up, and whether or not some of these closures become more permanent, or whether companies can handle a lesser demand load and still become profitable? What are your thoughts?
I think Steve is absolutely right. There's so much we don't know, Becky, and we've got to look at all the indicators we can get our hand off. You know, the economy was a very nice photo, and then it has turned into a jigsaw puzzle that's all messed up, and we're trying to put it back together, and we're trying to figure out, are all the pieces still here or not? So it's going to take time to figure it out. Key things to look at is, of course, the reopenings from a health perspective, consumer behavior, and business behavior. And we're going to get a lot more information on that in the next few weeks.
And Mohamed, we're also talking about this idea about how it's probably going to be different in different places. My guess would be in cities, particularly in cities that have had higher caseloads, you probably have more hesitancy on behalf of consumers, because maybe they know someone who got sick or who died. And that changes consumer perspective pretty drastically.
Oh, totally. I mean, the amount of difference is enormous. And the problem is that we are a very interconnected country and a very interconnected global economy. And different parts are going to go at different speeds. Even within families, I know within families, people who are willing to engage and others who don't want to go out, but they live in the same household, which raises really interesting dinner conversation. Becky, I think the key issue is that we are reopening. We are reopening in a bumpy manner, and we've just got to keep focused. But markets are completely divorced from this reality, because markets have stumbled into a win-win. You win if the reopening goes well, and you still win if it doesn't go well, because the Federal Reserve is in there in a big way. And I think that's why markets are in one universe and the real economy is in the other. And the real economy is going to get a lot worse. We already have two officials telling us that the unemployment rate is going to go north of 20%, and it is, unfortunately.
Is that the correct perspective, the market's idea that it's a win-win and it doesn't matter if the economy doesn't open up as much because the Fed will be there, the Treasury will be there?
It is if you're in the upper parts of the capital structure. So if you're in Treasuries, you can sell volatility because the Fed is there and is going to anchor that market. In investment grade, you can earn the extra yield because the Fed is there buying investment grade. High yield, a little bit more iffy. But when you go into equities, you're betting on an indirect Fed effect, that you're going to have a spill down, a waterfall effects, if you like, all the way down. So depending on where you are, and that's why most investment professionals are comfortable in the upper end, that's their strategic exposure. And when they come to equities, the strategic is limited to a few companies, and the tactical exposure is what goes through the indices.
Hey, Mohamed, let's do a little bit of a history lesson and look back at what happened after the Great Depression, when prices collapsed, but then the market came back for quite a while, I think till around 1937, until the government backed off a little bit. And that's when things got dangerous. So the Fed is saying now that it will do anything and everything, and there are no limitations. But are there limits?
So there's no limitations from the Fed's point of view if they have the Treasury on board. The Fed has the balance sheet, and if it has the willingness, it can go. And the difference between the Fed and the government is that the Fed can go straight to the markets, whereas the government's ability to get to the end user is much more complicated. The issues for the Fed is the collateral damage. They've become more and more of a quasi-fiscal agency, which exposes them to political risk. They have reputational risk if they buy things that go bankrupt, and we've heard bankruptcies are going to go up. So the Fed has to balance what it can do with what it should do. And I think that's where the judgment calls come in. A lot of us were surprised, not that it went in to buy fallen angel, investment grade names that became high yield. That makes sense. But it went in, it said it's willing to buy the index. And that's quite an aggressive move. And that has given the market a lot of confidence that the Fed backstop is solid.
The Fed backs up is solid as long as, you said, the Treasury backs it up. OK, we have a Treasury secretary who is definitely backing up the Fed at this point, but we also have an election in November. Do you think that would change if the Democrats win that election and a new Treasury secretary is appointed?
So, Becky, we are 2 months into this crisis, and already we're hearing Main Street versus Wall Street because the decoupling has been so big. Company versus people. Why are we saving companies when they're not keeping people? We have record unemployment coming up. We have record layoffs. So you see, rich versus poor. If you look at the employment report, it is the minorities and the young that got hit much harder than the others. So we're already having that political debate, and it's only been 2 months into this crisis. So yes, it has an important political angle. But I think up to the summer, well into the summer, we will get a third package, and I think you'll see both the Treasury and the Fed doing whatever it takes. The question mark is how far is the market front running that? Remember, they haven't bought a single bond yet in high yield space or investment grade space, but the market has priced it all in.